The Barbell, a strategy for managing the thrift savings plan in retirement, 2025 edition. Preface. First, let's talk about what this book is not. It is not financial advice to you. I don't know you. I can no more provide financial advice to someone I don't know than a doctor can provide medical advice to someone he's never met or interacted with. It is not the strategy of how to withdraw money from the TSP. It is a strategy. It might not even be a particularly good strategy. It is not a strategy that must be followed 100% or nothing. It can be altered and tailored as the user sees fit. There are no rules to this. Set your own. Take pieces and come up with what works for you. It is not a strategy I invented. I'm not that smart. There have been various versions of the barbell strategy kicking around for years now, maybe decades. If I knew who created it, I'd give them credit. So what exactly is this book then? It is meant to be a thorough explanation of how someone could employ the barbell strategy in conjunction with their TSP and IRA or other account were that person so inclined. It is in your best interest to talk with a professional about this strategy to see if it is right for you and your particular financial situation. I'm not recruiting any followers here. Remember, personal finance is very personal. The only account that matters is yours. Stop caring what other people are doing, including me. Chapter 1. What is it? Some time ago, I came across an investment management strategy that I thought would fit nicely with the withdrawal phase of an individual thrift savings plan, TSP. The withdrawal phase, you ask? Yes, at the risk of oversimplification, there are basically two phases to a person's investment career: the accumulation phase and the withdrawal phase. Typically, this means that during the accumulation phase, that is all you're doing, accumulating. This would be your working years for the federal government employee. There are no withdrawals normally. The TSP is a one-way street. Money is just going in, every pay period. The balance is steadily growing higher, hopefully. At some point, however, that phase comes to an end. It may be when you retire, or it may be a few years after that. For some of you, it may not be until age 75, when the required minimum distributions, RMDs, start kicking in. I guess your strategy seems to be planning on saving up until you're in your 80s, and then you'll really go wild, living the good life. Regardless of when your accumulation phase ends, there will be a time when you start to develop a plan for the protection of capital, what you've accumulated so far, and the strategy of how you will take withdrawals, the payoff for all those years of saving. This is the withdrawal phase, and in my experience, it's the more challenging phase. There's a lot more to think about, such as, how do I protect what I've built up? How do I know how much to take out? How often should I take money out? When should I start taking money out? What if I start taking it out and the market crashes? Maybe I should not be in the market anymore. These are the decisions that try men's souls, to paraphrase Thomas Paine. Saving is easy. Max out your TSP every pay period and that's it. The biggest challenge is deciding where to put it and if you should move it around based on what you think the market will do. Pro tip, you shouldn't. But come retirement, the easy part is over. Now it's decision-making time. And there are quite a few to make. Ever experienced the phenomena of overchoice? It's when you have so many choices to make, you don't know how to prioritize them, or even where to start, so you don't do anything. Or you make a hasty decision just to be done with the uncomfortableness. Overchoice can lead to paralysis, or panic, or both, and that ain't good. Enter the barbell strategy. First of all, we have to deal with the name. No doubt, it is an unusual one. Understanding the name goes a long way in understanding the strategy itself, though. Imagine a large barbell on the floor, like the ones Olympians lift after eating 10 million calories a year and strapping on a 12-pound leather belt. On one end is a lot of weight, On the other end is a lot of weight. In the middle, there is nothing, besides a guy getting ready to blow out his aorta trying to lift it. Let's translate this into the financial arena. Traditionally, an individual might have various investments on sort of a continuum of risk in his diversified portfolio. Imagine a horizontal line where the far left represents very safe and stable investments. Let's say an FDIC-insured savings account at a bank. Right next to that, the risk increases just slightly. Say some very stable corporate bond mutual funds. As we move farther down the right, we increase in risk and hopefully in reward. Maybe next time we have stock index funds, growth mutual funds, individual stocks, precious metals, and maybe finally some cryptocurrencies. If you don't understand these terms, don't worry, we'll get there. What you end up with is a line of investments that make up that individual's investment portfolio from safest to riskiest. Nothing wrong with this at all, but let's assume for a minute that we aren't that into managing a lot of different types of investments. Maybe we don't have an account that offers all those investment options. Maybe we don't even know what some of those investments are. Surely there is a way to simplify things for the person that is so inclined. What if we eliminated some of those investments? What if we just kept a really safe investment, the far left, and one that is riskier, the far right, and then we got rid of everything in the middle for the sake of simplicity? What would we have? Something that looks like a barbell. Investments on each end, but nothing in the middle but the now empty line. Make sense? That is the origin of the name of the strategy. The financial universe likes to take charts, patterns, strategies, and other esoteric, weird financial things and name them after common items. For example, you can employ a butterfly spread as an option strategy. There's a thing called a dead cat bounce. Bulls, bears, blue chips, haircuts, candlesticks, and teacups are all financial terms that are borrowed from the real world. They are employed in an effort to simplify or convey the strategy or characteristic of the thing being discussed. The barbell strategy is no different, that's all. Don't get too hung up on the name, but once you understand where it comes from, it does help to understand where we are going with it. So what does that mean for us? When we apply this philosophy or strategy to the TSP, we get something that looks like this. G fund all the way on the left, nothing in the middle, and say the C fund on the other end. You could substitute F for G and S for C, but in the interest of simplicity, I'll just use the G fund and the C fund. Notice we are eliminating the balanced L funds. Remember, we are not trying to spread risk across all funds, nor are we trying to diversify into everything. That's the essence of the barbell strategy: simplicity. This simplicity is meant to combat that overchoice paralysis we covered a little earlier, and I will explain how that works in detail a little further on. But for now, it might be helpful to take a step back and learn exactly what the Thrift Savings Plan offers in the way of investments. Chapter 2. The Thrift Savings Plan, a deep dive. As a little history lesson, the Thrift Savings Plan was born in 1986 during the switchover from CSRS to FERS, although there was no actual fund to invest in at that time. That would come a year later. The TSP is what is known as a tax-deferred retirement savings account, meaning that you can make contributions prior to paying income tax on the money. The taxes are deferred or postponed until another time. That time is when you withdraw the money. We are talking about the traditional TSP here, not the Roth TSP. It is also known as a defined contribution plan. This means that the government contributes a certain amount to each individual's account, and that amount is defined or set. It's not just some random or variable number. The rules are well established, and they state that the government will match up to 5% of an individual's salary in contributions. If you make $50,000 and you contribute 5% of your salary, $2,500, the government will contribute $2,500. However, if you contribute $6,000, the government still will only contribute the $2,500. The contribution is limited or defined to 5%. The TSP is the largest defined contribution plan in the world. There is over $800 billion invested in the TSP among approximately 7 million accounts. The entity that oversees the fund is the Federal Retirement Thrift Investment Board. To simplify things, it is like the government employee's 401k plan. Each pay period, money goes into your account. This money grows throughout your entire career, and when you retire, you hope to have put a large pot of money that at worst gets you through your living expenses in your later years, and at best allows you the freedom to travel, enjoy yourself, and generally live in comfort and security. So what happens to your money from the time it comes out of your check until it comes back to your bank account a few decades later? Well, that depends on where it spends those decades. The G Fund. You can invest your TSP in a number of options. The first fund is the G Fund. It was created on April 1st, 1987. At the risk of oversimplifying it, the G Fund is a government bond fund. What's a bond? A bond is a loan. Let's use a simple example. When you buy a government bond, you are loaning your money to the federal government. In turn, they pay you back a little bit of money every so often. This payment back to you is called interest, and this payment back to you is for a set time, or in bond speak, the term of the bond. When the term of the bond is up, it is said to have matured. At that point, you get your original purchase price of the bond back, and you will have gotten all the interest during the time you loaned out the money. On some bonds, you get the interest periodically, and on some bonds, they save all the interest and give you everything back at the end, the purchase price plus all the interest all at once. In the G Fund, all of the money you invest gets pooled with all of the other people that are investing in the G Fund, and the TSP buys or invests in special government bonds. You may have heard of the term treasuries or treasury bonds and treasury bills. That's what this G Fund is buying. However, there is something a little special about the G Fund, something that the general public cannot buy. Everything else available in the TSP, F, C, S, and I funds are also available in the private sector, or at least their equivalents are. Not so with the G Fund. The G Fund consists of very special government bonds created for and sold to only the TSP. What's so special about them? Normally, when you buy a bond, the longer the term of the loan, the higher the interest rate. It only makes sense, right? If you're going to loan your money to someone for 10 years and have your money tied up for that long, they'll need to compensate you for that accordingly, right? The bonds the TSP uses pay long-term rates, but are actually short-term securities. You can redeem your G Fund on any given day. You don't have to wait until a bond matures to get your money out of it. That means not only are you getting paid the higher long-term rate, but you don't have the downside of having to tie your money up for a very long time. Also, unlike bonds in the private sector, the price of these bonds don't fluctuate or move up and down. The only variable is how much interest they pay you. Again, the general public doesn't have access to this type of bond. This has the effect of making the G Fund riskless in the sense of no loss of principal. Your money won't go down being invested in the G Fund. However, the interest they pay you for the year can get really low. And in 2020, it did just that. The interest was less than 1% for the entire year, an all-time low. In 2021, it did much better, bringing in a whopping 1.38%. Not exactly Bitcoin-like returns. Well, at least when Bitcoin is actually making money. But the money you put in will always be safe. Safe as long as the federal government is able and willing to honor its debts. In 2022, the G Fund returned 2.98%. Better, but not great. Think of it as a pretty good savings account. 2023 brought a more reasonable 4.22% return, closer to its long-term average of 4.66%. 2024 was 4.4%, so we're heading back to normal. The bottom line, the G Fund is the least risky, but you ain't getting rich off it. Characteristics of the G fund. Almost no credit risk. As long as the government pays its bills, you get interest. No loss of principal. Not available in the private sector. Invest in government securities not available to the general public. Since its inception in 1987, it has averaged an annual return of 4.65% as of end of 2024. Its return in 2024 was 4.40%. The F Fund. The F Fund is the other bond fund in the TSP. There are only two. It started on January 29, 1988. It works quite the same way as the G Fund in the sense that you are investing in bonds. You're still loaning your money to an entity who promises to pay you back in the future. But who are you loaning your money to exactly? In this case, you're buying government bonds, but you're also buying private bonds, such as bonds from large companies, or bonds backed by assets, or even bonds based on other loans. Let's not get too complicated here. Watch The Big Short, entertaining and educational. But you don't have any special protection or privileges like the G Fund. You can lose money in the F Fund. The prices of these bonds can go up and down based on a number of factors, interest rates being the main one. Bonds confuse even finance majors, so I don't want to dig too deeply here, but here's one truth. When interest rates go down, bond prices go up. See, that's confusing. But it's worth understanding if only because when inflation starts to come back, bond prices will go down. In nerd speak, there's an inverse relationship between interest rates and bond prices. In regular speak, that means that they move in opposite directions from one another. What happens when you buy something and the price goes down? You lose money. Do bond prices go crazy high one day and crazy low the next, like you may see in the stock market? No, not normally. Interest rates change over a period of years typically, not a period of days. That means a bond fund should theoretically be a little more stable than a stock fund, which we'll get to in a minute. Bond funds don't normally earn 30% in one year and lose 20% in another year, especially the F Fund, but the CNS funds have had fluctuations like that in their history. This is why you will often hear people say that the F Fund is less risky than the C, S, or I. What they're probably trying to say, but not using the exact terminology correctly, is that it is less volatile than the stock funds. This is why you will often hear people say that the F Fund is less risky than the C, S, or I. What they're probably trying to say, but not using the exact terminology correctly, is that it is less volatile than stock funds. And that is normally true, but there's still the possibility of a loss in the F Fund. Since you can lose money, you would expect it to pay a higher interest rate in the long term than the G Fund, right? I mean, if you're taking extra risk, you want to be compensated for it. Otherwise, why wouldn't you just invest in the riskless G Fund? Well, if you're thinking like this, you have a future in investments. You do indeed get paid a little more for the extra risk. Since 1988, the F Fund has averaged 5.25% a year versus the G Fund's 4.65% as of end of 2024. In 2022, the F Fund had its worst year ever, losing 12.83%. Pretty drastic for a conservative investment. Ouch! 2024 was a little better at a positive 1.33%. How does the F Fund pick which bonds to buy? That leads us down yet another side trail, but one that's very important for every fund except the G Fund, so we need to talk about it for a minute or two. Index funds. If you watch CNBC or read any investment websites, you'll hear the term index funds. You already know the fun part, people pooling money together to buy things, but what is an index? An index is simply a predetermined number of investments that people group together because they provide a way to track the performance of something. I know, just bear with me. There are probably two that you already know, the Dow Jones Industrials and the S&P 500. It is common for the news to report these indices each day as a way of saying what the market is doing. But neither one of these is actually the market. They are only pieces of the market. The Dow Jones Industrial Average, DJIA, is only 30 companies. 30 out of thousands of companies. The DJIA, or sometimes just called the Dow, contains big companies that you've probably given some of your money to. Home Depot, Coca-Cola, Disney, Nike, Walmart, Apple, and so on. These 30 stocks get grouped together and then tracked numerically. If the stock price of all the companies goes up for that day, the Dow goes up. If they all go down, the Dow goes down. If they are mixed and only some go up, then the algorithms do their black magic and spit out whether the Dow was up or down based on the total price movements of all the stocks. That is an index. So how do we invest in indices? Did you know the plural of index can be both indices and indexes? Well, we do it through mutual funds, or in our case, through the funds in the TSP. An index mutual fund that tracked the Dow would have in its rules that it must buy these 30 stocks and only these 30 stocks. Whatever that index did, your fund would do. We don't have the Dow Jones option in the TSP, but let's speculate for a second. Let's say that we had a D fund, and it was the DJIA. We put our money in the D fund every pay period. The TSP would buy those 30 stocks and only those 30 stocks, and in the proportion that the companies were represented in the DJIA. If someone thought, hey, we should buy Tesla or GameStop, they're really going to take off, they would be prevented from doing so. Why? Because these companies are not in the Dow, and our fund tracks the Dow. Rules are rules. They help make sure the investor knows what he's actually investing in. What this means is that in an index fund, no one is trying to beat the market. They're trying to copy the index. There's not a team of people sitting around all trying to come up with new investment ideas. The formula and rules are set. They buy the index. Period. In this case, they buy the 30 stocks. No more, no less. There's no research or speculation. This typically makes index funds cheaper because you aren't paying a bunch of geniuses large salaries to sniff out the next hot stock. Let's help explain index funds by contrasting them with actively managed funds. In an actively managed mutual fund, the manager's hands are not tied by rules saying they can only buy stocks in a certain index. In many of these funds, you do have a bunch of highly paid geniuses sitting around trying to come up with the next great investment, unencumbered with ultra-rigid rules related to indexes. These guys actually are trying to beat the market. All we have in the TSP are index funds. We do not have funds that are actively managed. In other words, we don't have funds that are actively trying to go out and find the next hot drug stock or the next DoorDash or whatever. Like the DJIA, the S&P 500 is also an index fund. What stocks does it track? The 500 largest or most influential U.S. companies. Remember that. The 500 most notable U.S. companies. Most of the DJIA companies are also in the S&P 500. Apple, Walmart, Nike, etc. The C Fund tracks the S&P 500 index, but we're getting ahead of ourselves. Back on track. We're done with our brief rabbit trail of what index funds are. What was the point of all that? Well, you had to know what an index fund is before I could tell you what index the F fund tries to track, and it's probably one you've never heard of. The Bloomberg Barclays Aggregate U.S. Bond Index. Yeah, I know. The what? I don't know if this thing has an acronym or nickname, but I'm about to give it one because I'm already tired of typing it out. The BBA-USBI is an index that contains over 10,000 bonds. Yep, 10,000. That's a lot to keep track of. And there are some stipulations. For one, the bonds have to be in the U.S. bond market. We aren't lending money to a cattle operation in Buenos Aires. The F Fund tries to track that index, but it doesn't do it exactly. It would be difficult to buy and sell 10,000 or more bonds to match the inventory of the BBA-USBI down to the individual bond. So the TSP allows BlackRock Institutional Trust Company, our contracted TSP manager, to buy a similar number of these bonds that will replicate the BBA USBI's performance as closely as is reasonably possible, and has been very close over the years. Unlike the DJIA and the S&P 500, the BBA USBI is not widely reported every day. You will never hear someone say, "How did the market do today?" and understand them to mean this particular index. But it is tracked, and you don't have to be in the TSP to be able to purchase something exactly like the F fund. If you are interested in seeing how it has performed by tracking other funds, you can look at Vanguard's Total Bond Market Index Fund, VBM-FX, and Fidelity's U.S. Bond Index Fund, FXNAX. Both of these funds do what the F fund does and replicates the performance of the BBA USBI. I want to be clear on that last point. If you have your money outside the TSP and wanted to have essentially the same thing as the F fund, you could. You would just buy one of the above funds or any other fund that tracked the same index. We'll get into this more in a few minutes, but understand the TSP doesn't have a lock on the index fund it offers. Characteristics of the F fund. Invest in U.S. bonds with maturities of more than 1 year. Can lose principal. Tracks the Bloomberg Barclays Aggregate U.S. Bond Index. Available in the private sector by many big-name mutual fund companies. The C Fund. We're done with the 2 bond funds, G and F. The next 3 funds are stock funds. Is a stock different than a bond? Yes. Time for Finance 101. These are 2 primary ways to invest in a company, as in give them your money for something in return. Let's take a company most of us are familiar with as an example, Nike. We already talked about bonds. If we were to loan Nike $1,000, we would do that by purchasing a $1,000 bond from Nike. Nike would agree to pay us, say, 3% or $30 a year for 5 years, at which point Nike would pay us back our original $1,000. Like your mortgage, the loan is for a set amount of time at a set interest rate. The other important distinction is when you bought that bond, you didn't own any part of Nike. You didn't become part owner or have any claim on any income Nike made. If they made billions, you still only got your $30. Conversely, if they lost money, they were still obligated to pay you that same $30. You were a creditor of Nike. You were not a shareholder. Stocks are different. If you buy Nike stock, yes, the company is getting your money, but in return, you are getting something different than interest payments. You are now part owner of Nike. Nike may have issued 80 million shares of stock and you may only own 5 individual shares, but nonetheless, you're part owner of that company. You are a shareholder. If the company makes money and divides the profits up among the owners, dividends, you get part of those profits. When it comes time to vote on things in the business, you get the right to vote. There's no maturity date or expiration date for the stock. You can hold those 5 shares until you die and pass them on to your grandkids. Stock is the term for the collection of all of the stock of a company. The collection is broken down into individual units that are called shares. You can buy 1 share of a stock if you want. It is not unheard of for people to buy 1 share of Disney stock, have the certificate framed, and then given as a gift to a Disney fan. These days, stock certificates are not issued as a general rule. The broker keeps a record of what you own in your account. In the old days, the New York Stock Exchange was founded in 1792. You did in fact take receipt of your stock certificates. Not today. Too much paperwork, and you would have to send them back in when you sold them. Imagine the hassle. But you can get your stock issued to you in certificate if you wanted. I have a few lying around. When this is done today, it is almost always as a novelty or gift. Stocks are much more common for the average person to own. Most people don't buy individual bonds, but they will buy Amazon or Airbnb or whatever the next hot tip is that they get from their barber. As I said, sometimes people buy just 1 share of a stock. Now, you don't even have to buy that much. Just within the past few years, both Schwab and Fidelity have come out with a product called slices. A slice is literally just one piece of one share. You don't have to buy one whole share anymore. A slice costs $5 and is a percentage of that stock. Are you a huge Disney fan? You can have $5 a month taken out of your account to buy Disney stock. It is literally that easy. In the TSP, we cannot buy individual stocks like we can in our IRAs. If we want to participate in the stock market, we do it through one of the TSP stock funds that invest in the market. When they are referring to the market these days, it might be that they are referring to the S&P 500. It was not as popular when I was a kid. By far, the Dow Jones was the main indicator. But lately, the S&P 500 has garnered a lot more attention. As I mentioned, it is the 500 biggest U.S. companies that are publicly traded. Publicly traded means you can buy shares in the companies on an exchange. It contains the companies you know like Microsoft, GE, Ford, Disney, and just very recently, Tesla and Airbnb. You have to be a big company to be included. Why is all of this important? Because when we are talking about the S&P 500, we are talking about the C fund and vice versa. The C fund is not actively managed, remember? It is simply tracking an index, and the index it is tracking is the S&P 500. This is an extremely common index. Having 500 companies to invest in really spreads out the risk if one company goes bankrupt. Having them all be U.S. companies means they're regulated by the SEC, and theoretically, the reports and financial statements can be relied upon. Finally, these are the companies that are making America great, and since we have historically had one of the greatest economies in the world, it makes for a very popular investment. It also takes the guesswork out of wondering if you should buy Lowe's at a certain price or if you would be better off buying Home Depot. You just give the mutual fund company your money and they buy all 500 of the biggest companies. Done. No hand-wringing over when to sell Harley-Davidson or Ford. You don't. The S&P 500, and therefore the C Fund, have done well historically, especially over the last 10 years. They have averaged over 13% as of 2024. The C Fund was born into the TSP on January 29, 1988, same day as the F Fund, and since then has averaged 11.17% a year as of 2024. Many companies have S&P 500 index funds you can buy. Vanguard 500 Index Fund Admiral Shares, VFIAX, is one. Schwab S&P 500 Index Fund, SWPPX, is another. Fidelity and many more have them too. Again, it's a very popular fund. No less than the great Warren Buffett once said, a person who didn't want to pick stocks could do a lot worse than just 90% in the S&P 500 and 10% in government bonds. In case you're wondering, that would be 90% C, 10% G for us TSP heads. As I mentioned before, the C Fund is what we will be using to illustrate our barbell when we get to it. But first, we have two more funds to talk about. Characteristics of the C Fund. Tracks S&P 500 Index. Stock fund that buys shares, not bonds, of companies. Widely available at very low cost from Vanguard, Fidelity, Schwab, and others. Diversified over 500 of the largest U.S. companies. The S Fund. Here we have another stock fund, and we have one that also invests in U.S. companies only. But unlike the C Fund, it specifically excludes the 500 largest or influential companies. It is all of the companies other than that. You can think like this. Company number 501 and down is what is in the S Fund. Technically, there are some S Fund companies that are bigger than some of the smaller C Fund companies, but on average, these are smaller, less influential companies. How many stocks does this have in it? Over 3,700 and changing all the time as one company goes away and another one comes on the scene. You can see the variety. The DGIA had 30 stocks, the S&P 500 had 500, and this one has over 3,000. By the way, there are also S&P 100, 200, 300, and other indices, but they aren't as popular. Hopefully by now, you're getting the picture that there are all kinds of indices, and they all serve a different purpose. We are really only concerned with 4 as TSP investors. Which one is the S fund trying to match? Another mouthful. The Dow Jones Completion Total Stock Market Index. If you want to track the index itself, its symbol is DWCPF. I want to point out a few things when we're talking about the S fund. It does not include anything that is in the C fund. Likewise, the C fund does not include anything in the S fund. If you own the C fund, you own the 500 largest U.S. companies. If you own the S fund, you own all the U.S. companies smaller in size or influence than that. If you own both, you own all U.S. companies, and there's something to be said for that. The S fund is a tad younger than the others. In fact, when I first came on the job, the S fund was not an option yet. It was born on May 1st, 2001. Since that time, it has averaged 9.33% annually until end of 2024. In 2024, it returned 16.93%. Like the C fund, you can buy the S fund on the private market as well. You are looking for something that is replicating the Dow Jones Completion Total Stock Market Index. Vanguard Extended Market Index Fund Admiral Shares, VEXAX, is one. One of the things that I want to make clear to you, whether you go with the barbell strategy or not, much of the TSP is available outside of the TSP, just under different names, and much of it is available at the same low fee expense ratio. Just something to keep in mind. More on that later. Characteristics of the S fund. U.S.-based companies. Small and mid-cap stocks. Over 3,700 companies. Nothing overlapping the C fund. Slightly more volatile than the C fund. Tends to have higher highs and lower lows. S fund fees are slightly more expensive than C fund fees, 0.079% versus 0.048% for 2024. Finally, the I fund. This is the one I love to hate. It is the international fund of the TSP. By that, hopefully you can deduce that it is not purchasing U.S. companies. Therefore, if you have the I fund, you are not holding anything that is also in the C or S. In fact, you can remember this. All of the stock funds in the TSP are independent of one another. It also started on May 1st, 2001. Since that time, it has averaged a whopping 5.01% a year as of 2024. Remember, the G fund has averaged 4.65% over its life, and it's guaranteed by the government. What exactly is my problem with it? Well, for starters, I would encourage you to reread the previous sentence. 5.01% a year is not necessarily a bad thing if it were in an investment that was fairly risk-free or not very volatile. The I fund is neither. In the past decade or so, it has had swings of negative 42% in 1 year, and a positive 30% in the very next year. The I fund should come with a case of Tums. That's a lot of volatility. Now, if it's paid off in the long run, that would be one thing. You could cut it some slack if it averaged, say, 15% over a couple of decades, but it hasn't. Only averaging 5.01% over the long haul, well, that's just downright unsatisfactory. What exactly does it invest in? It seeks to match the investments inside the, get ready, Morgan Stanley Capital International Europe, Australasia, and Far East Index Fund pre-2024. That is the MSCI EAFE for short, which isn't all that short, come to think of it. As the name implies, it avoids any companies in Canada, Mexico, or South America, which has had some pretty hot companies over the last couple of decades. It also conspicuously excludes China, which has had some of the hot companies over the last couple of decades. People other than me are fed up with the I Fund as well. Legislation was introduced to change the I Fund to match another index. Remember, there are tons to choose from. People want an international fund that is taking advantage of other markets. The sticking point is that some want to be able to invest in China, where there's tremendous opportunity for growth. Others see that as a threat to national security that had to be worked out. It was. Enter 2024. Now we have, inhale deeply, the Morgan Stanley Capital International All-Country World Investable Market Index ex-USA, ex-China, ex-Hong Kong Index. Yes, that's the actual name. Abbreviated to MSCI, ACWI, IMI, ex-USA, ex-China, ex-Hong Kong Index, which isn't actually all that much of an abbreviation. Characteristics of the I Fund. Volatile. Recently changed from MSCI EAFE to MSCI ACWI IMI ex-USA, ex-China, ex-Hong Kong. Invest in companies all over the world except US, China, and Hong Kong. The worst performing of the 3 TSP stock funds. 2024 return was a paltry 4.27%. The L funds. This requires a point of clarification. The L funds are not separate funds. There's nothing new in any L fund that we have not already talked about. The L funds are just different combinations of the 5 funds we've already covered: G, F, C, S, and I. The higher the number, 2070, the more the fund invests in the 3 stock funds. The lower the number, 2030, the more the money is concentrated in the bond funds. They adjust quarterly and they adjust automatically, getting more conservative as the date gets closer. The L funds don't really have a place in the barbell strategy because they are balanced and automatically change their composition over time, regardless of what the market is doing. Those are 2 things that defeat the purpose of the barbell strategy. That is not to say they are not good or don't have their place. For some, they may be the absolute perfect strategy. Diversified across all funds and no need to adjust. They do it for you. But that's a different strategy than this book, so we'll quietly leave the L funds in peace and finally move along to getting back to the strategy at hand. Summary. If you remember, we were talking about investment options in the TSP to lay the groundwork for why I use what I use in the barbell strategy. Hopefully, the previous pages were useful to you, whether you are looking to use that strategy in this book or not. I have found the more educated an individual becomes in the investment world, the easier the decisions get. It is my wish the not-so-brief overview of the TSP helps in that regard somewhat. Chapter 3. How to structure the barbell strategy. As we learned from our TSP section, which feels like we started 3 weeks ago, we have a very safe investment, the G Fund. If we had a goal of protecting what we had earned, the G Fund would be the only one in which we could have reasonable confidence that it would not go down. Think of it as your emergency savings, because really that's what it is. We will use this as one side of our barbell. It's the safe money. The money we may need to keep around for short-term living expenses. The non-discretionary money, if you will. At the other end, we are okay taking a little more risk. We want that money to grow. That allows us the choice between the C, S, or I funds. However, we have a qualification to add. We want that risk to be worth it. We don't want to take a lot of risk, but then expect to have a 5% return. The risk-reward ratio is skewed too far to the risk side because the potential reward component is so low. So we axe the I fund. That leaves us C and S. I won't argue strongly on this point in case you feel otherwise, but here's my thinking. Over the last 10 years, the C fund has been the strongest performer. It's beaten the S. It also tends to be less volatile. It has swings up and down to be sure, but generally they are not as wild as the S. Personally, I prefer less volatility, all else being the same. Not least, the C fund contains the bigger 500 companies in the US, as you know if you waded through my TSP chapter. I like big companies that are stable. It is comforting to me. C fund fees are also lower than S fund fees. For these reasons, I'll go with the C fund for my other barbell end. If you feel strongly in favor of the S fund, I'll still come to Sunday dinner at your house. There's not that much spread between the two, but since I'm talking about stocks for an older, calmer me and not a turbulent youth, I'm happier with the C fund myself. If you want to use the S, feel free. As I mentioned earlier, tailor this strategy to what best suits you. You could even split the right side between the C and the S, but then you complicate things, and keeping it simple is one of my goals. So why not the F fund? If you noticed, I just glossed right over that. For long-term, inflation-beating investing, it really has to be equities. Equities is another name for stocks. History has shown that stocks are best at beating inflation in the long run. Being a bond fund, it is conservative and not a lot of upside potential, and also susceptible to interest rate risk, which I personally anticipate we will see more of in the coming decade. When the dust finally settles from all of that, G and C are standing. Finally, we've gotten somewhere. Maybe more from the process of elimination than anything else, but at least we have both sides of the barbell now. We'll continue with our setup by creating a fictional Fersonian to help illustrate how to implement the method. Chapter 4. How to implement the strategy. Let me introduce you to Jeff Fersonian. Jeff just hit his MRA and can't stand one more day of Uncle Sam's cubicle farm. 30 years of moving paper from the inbox to the outbox was exciting enough for one lifetime. He's gotten his agency estimate, made a copy of his EOPF, verified his beneficiary forms, submitted his papers timely, and is now just waiting for the day, December 31, 2017. I'm using a past date to show exactly how the barbell strategy would have worked using real historical returns. This book was initially written in 2020 and has been updated annually since then. Let's assume a few other things about Jeff. He's got $800,000 in his TSP. He's never been one to put a lot of time into what to invest in. Now he wants to get a little more serious about it. He's done some preliminary planning and feels comfortable he can pull out $2,000 a month from it as soon as he retires. He would rather supplement his annuity with TSP withdrawals instead of working a part-time job. Since he's already hit his MRA, he realizes his first supplement would be reduced if he worked significantly anyway, another reason to withdraw from the TSP. He wants to travel with his wife Judy and enjoy himself while he's still in good health. Jeff is planning on taking out $24,000 a year. He realizes that he can move his entire TSP balance into the G fund and protect it, but he is concerned that's a little too conservative. He's looking for a better approach. He wants to still let a little of his money work for him for his later years. He finally decides on the barbell strategy he's been reading about at the ever-sarcastic, borderline competent, REM sleep-inducing barfieldfinancial.com. He knows he's going to protect some money in the G fund and let the rest of it work for him in the C fund for the long term. But how much? How does one even start to determine such a thing? Step 1. How much to protect? Since Jeff has already had his last performance appraisal and he's going to retire in a couple of months anyway, he's got no problem spending a little more time at work reading up on the stock market. He's learned that most market crashes, or corrections as the financial nerds call losing money, generally only last a few years, sometimes even less, although in a few instances it's been even longer. Jeff understands the concept that if the market is down and he withdraws money, he's locking in his losses and he's hurting his balance even more. He's selling when it's low, which means he's pulling a larger percentage of the total out, and he definitely doesn't want to do that. So he comes up with a time frame of 5 years, a cushion, if you will. He'd like to have at least 5 years of withdrawals protected in the G fund so that in a worst-case scenario market crash, he can pull from his G fund for a full 5 years before he's forced to sell any of his C fund. The hope being that within 5 years, the market is back up and even higher than before. In the good years, where the C fund makes a lot of money, he'll take those gains and replenish his G fund with them. This way, he'll, hopefully, always maintain 5 years' worth of withdrawals in the G. Jeff decides that $24,000 a year times 5 is $120,000. That means he needs to keep at least that much in the G fund. But that doesn't seem like that much the more he thinks about it. He wants an extra cushion for inflation and maybe a little extra here and there for bigger expenses, so he decides to round up to an even $150,000. He will have $150,000 in the G fund and the remainder, $650,000, in the C fund. That works out to roughly a 20% G and 80% C allocation. After thinking about this and talking it over with Mrs. Fersonian, they decide this might be a little too aggressive still. Jeff decides to round up again to 30% in the G fund. This works out to be $240,000 in the G and $560,000 in the C. It isn't lost on Jeff that he now has 10 full years of $24,000 annual withdrawals protected, not adjusted for inflation, of course. This gives him more peace of mind than he had anticipated. He's actually feeling confident and in control of his TSP finally. After years of just hoping he was doing the right thing in his TSP, this feeling of investor confidence is a new and welcomed one for Jeff. Step 2. The TSP Withdrawal Hurdle. Retirement day is drawing closer. Jeff is enjoying his last Thanksgiving as a federal employee with family. Just a little over a month to go now. Since he's trying to max out that final annual leave check, he didn't take any annual leave. But he had a few dangling sick days to burn, so he used one on the Friday after Turkey Day. Over the weekend, Jeff was reading some more on how to make withdrawals from the TSP and came across something that made him panic. You cannot direct the TSP to pay you from only one fund. They will pay you proportionally across all the funds you have. Wait a second. Jeff read that again. If he wants to withdraw only from the G fund, the TSP won't let him. They will pay him from both the G and the C in the proportion that he has his money allocated. In this case, it would be 30% G and 70% C. This means that if the C fund is down, the TSP will still cash some of that in to send Jeff his check. In other words, if Jeff wants $10,000 to come out of his TSP G fund, he doesn't have that option. $7,000 will come from C and $3,000 will come from G. Oh no. This completely destroys Jeff's strategy. He keeps reading. TSP money can be transferred to an IRA in retirement. Aha! That's the workaround, thought Jeff. He will leave his $240,000 in his TSP and put it all in the G fund. The remaining portion he will direct transfer to an IRA he has set up at Charles Schwab. Jeff already knew the C fund is just an S&P 500 fund, and he can get those anywhere. He makes his plan to move $560,000 into the Schwab Mutual Fund with symbol SWPPX once he retires. He's feeling better again. Time for another turkey sandwich. What's an IRA? An individual retirement arrangement. It's like a private investment account that has special tax benefits. You can set them up at different companies, all the companies named in this book to be exact. Because they have certain tax advantages, they come with special rules regarding withdrawals, transfers, and what age your funds are available without penalty. Typically, within an IRA, you can purchase mutual funds, stocks, and more. Think of it like a TSP for the private sector, but instead of only 5 investment funds, you have virtually unlimited options. Withdrawal options are also typically more lenient than what the TSP allows. Step 3. Execution. New Year's Day, 2018. Jeff wakes up unemployed for the first time since he was a teenager. Life is good. Stress is gone. Plans are developing. He spends the next few months tackling things he has been either too busy or too tired to get to. He spent more time with family, and his health is the best in years. So far, the annuity and the lump sum annual leave, along with some savings, have been more than sufficient. But now the weather is turning warm, and he wants to start traveling. He needs a little bit more money than his annuity provides. He finally submits the paperwork to move some of the TSP money into Schwab. During this process, Jeff realizes that TSP money moves proportionally too. They won't just transfer the $560,000 that he has in the C fund. They will transfer some of the C and some of the G. After he thinks about it for a minute, he comes to the conclusion it's really no big deal. Jeff just transfers $560,000, and once the money is out of the TSP, he does an interfund transfer to move the remaining $240,000, 100%, into the G fund. He then sets up his monthly withdrawals of $2,000 starting in June and gets on Travelocity. Step 4. Annual adjustment. December 2018, Jeff has been pulling $2,000 a month from his G fund for 7 months now. He has decided that he will analyze how his accounts have performed for the previous year each January. That will determine where he will put his money for the upcoming year. As December 2018 ends, the G fund returned 2.91%, and the C fund, S&P 500 actually, lost 4.41%. Well, that's not great, thought Jeff. While 4.41% is not a huge loss, I still don't want to lock it in. I think I'll just continue pulling from the G fund for 2019. After all, this is why I have this strategy. Jeff has made the decision that he will decide late December or early January from which fund to pull the following year's money. It's a once-a-year decision, not something that he revisits every month. After all, he's in retirement mode. All decisions get made using the easy button. So, for 2019, the plan is 12 months of $2,000 withdrawals from the G fund. Revisit again in January 2020. Done. Back to life. Man, managing money is easy. Let's take a quick look at where Jeff is as of December 31, 2018. G Fund started the year at $240,000. Jeff made 7 withdrawals of $2,000 each, $14,000 total. The G Fund earned 2.91% in interest. For the sake of simplicity, let's say the 2.91% was on the ending balance, which is wrong, but errs on the conservative side. It enables you to follow the math better. Year 2019. January of 2019 adjustment. Since the S&P 500 lost money in 2018, Jeff won't transfer money from the IRA to the TSP. Remember, he doesn't want to sell when the S&P 500 account is down, so there is no adjusting transfer to be made. Jeff has made the decision to pull 2019's monthly withdrawals directly from the TSPG fund again. Jeff understands the concept of inflation and how that over time, the $2,000 a month withdrawal will have to be increased. But he got along just fine last year, and he sees no identifiable increase in his expenses on the horizon for 2019. So for now, he sees no reason to raise the monthly amount just because some report came out saying there was a tiny bit of inflation last year. Jeff is really enjoying retirement all through 2019, still pulling out $2,000 a month from his G fund. Time flies when you're having fun, and before he knows it, the end of another year is here. Time for the annual 5-minute review of his retirement fund, and time to plan the 2020 withdrawals. December 31, 2019. When he looks into, whoa, the G fund did about the same, 2.24%, but the S&P 500 in his IRA made 31.45% in 2019. That's a nice score. Jeff did the math. The IRA started this year at $535,304. If it made 31.45%, that means his balance increased by $168,353. That's a no-brainer. No reason to damage the G fund moving forward. He'll pull his $24,000 in 2020 from the IRA. He'll even move a little over to replenish what he's already taken out from the previous years. Back to the pad and paper. In 2018, I took out $14,000. In 2019, I took out $24,000. That's $38,000 I want to replenish back into the TSP. I also need to plan to pull out my $24,000 for 2020 as well. That totals $62,000. I'll move $62,000 from my Schwab IRA to my TSP and still have a bigger IRA balance, because the total of the money I'm transferring is well under my profit of $168,000. Jeff has another hurdle to overcome at this point. He's not quite 59 and a half yet, the age you have to be to withdraw from an IRA without paying the 10% early withdrawal penalty. He doesn't have to pay it when he withdraws money from the TSP because the TSP has different rules. If you retire in the year you turn 55, or 50 for special category employees, you can withdraw from the TSP penalty-free. Jeff still has one more year until he's 59 and a half, which means he has one extra hurdle to jump through. He can't pull directly from the IRA without getting dinged an extra 10%, but there is a simple solution. What he can do is transfer the $62,000 back into the TSP, and then continue with his $2,000 a month withdrawals from the TSP G fund. And that's exactly what he'll do in January of 2020. At this point, it is worth noting a few things. Jeff has been pulling a steady $2,000 a month since he retired, and his investments are now over $100,000 higher than when he turned in his papers. Jeff still has over 10 years' worth of withdrawals protected in the G fund, again, not adjusted for inflation. Let's continue with the example. Year 2020. January 2020 adjustments. Since Jeff made money in the IRA in 2019, he wants to adjust or transfer this money from the IRA to the TSP G fund. As we just discussed, he wants to replenish 2018 and 2019 G fund withdrawals, as well as preparing his 2020 withdrawals. So he transfers all of that money into the TSP, $62,000, and continues to pull from the TSP throughout 2020. Even though he's pulling from the TSP, the money he's withdrawing actually came from the IRA profits. Jeff continues living the dream, knocking that TSP for $2,000 a month without a care in the world. December 2020 gets here and it's planning time again. Jeff discovers the G fund had the lowest return in its history, less than 1%, just a measly 0.97% to be exact. Terrible, but it doesn't matter. That C fund put in another stellar year at 18.31%. Another easy decision for Jeff. 2021's withdrawals will be from the profits of the C fund. But he's going to change things up a bit. For one, he's going to start pulling directly from the Schwab account since he's now over 59 and a half. No need for that extra hoop to jump through of transferring money back into the TSP. Since he automatically has his TSP payments coming in the form of $2,000 a month, he'll need to cancel them. This is easily done these days under the new TSP rules. This was not possible just a few years ago.
It used to be once you turned on that faucet, you could slow it down once a year, but you could never stop it. Thankfully, the TSP changed that. I think they saw the post-retirement transfers flooding out of the TSP and realized they needed to get with the program. So Jeff is comfortable with his strategy, and he's going to move up the withdrawals from $2,000 to $3,000 a month and pull them directly from his IRA. He puts on some Jimmy Buffett, hits the big red easy button, and decides to live a little. Year 2021. January 2021 adjustments. Things get easier now that Jeff is 59 and a half. He no longer has to transfer profits from the IRA to the TSP. Now he can just pull from either fund that has the profits as we stated above, so no adjustments needed. What will happen to Jeff? He's now taking $36,000 in withdrawals this year, $3,000 a month. We'll have to monitor his progress and see how the barbell strategy holds up for him. So far, so good. So good, in fact, Jeff is a millionaire just from his investments. If you do the math, you'll see Jeff's investment balance is $200,000 more than when he retired, and he has been pulling out money for several years now. We will just have to wait and see what 2021 has in store for Jeff. And welcome back. 2021 is over. I am updating this paper in real time, so here I am checking in on Jeff on Sunday, January 2nd, 2022. We'll see how 2021 treated him, and we'll see what he's planning on doing for 2022 regarding withdrawals and asset allocation. If you'll recall, in early January of 2021, Jeff decided to start taking $3,000 a month from his retirement savings. This was an increase of $1,000 a month from his previous $2,000 a month. And because 2020 was such a great year in the stock market, he was going to take those $3,000 a month for all of 2021 directly from his S&P 500 account at Charles Schwab. That's a total of $36,000 withdrawn from his IRA in 2021. 2021 was another stellar year. Even though Jeff pulled $3,000 a month from his TSP, his account still grew by over $170,000, and he's still a millionaire, even after 4 years of retirement. Now might be a good time to just take a break and look at a short synopsis of where Jeff stands currently. He retired on December 31, 2017. Total TSP balance at the time was $800,000. In 2018, 2019, 2020, and 2021, Jeff removed a total of $98,000 in withdrawals from his investments. On December 31, 2021, Jeff's total investment balance is now $1,187,728, or almost $400,000 more than when he retired. Remember, Jeff has not rolled any other retirement balances into his investment accounts, and being retired, he has not been able to contribute any additional dollars to the TSP. Jeff remembers when he and his coworkers used to worry about not being able to contribute to their TSPs when they retired. That concerned them. They thought that their accounts really couldn't grow if they weren't continuing to add to them. In fact, Jeff remembers some of his coworkers delaying retirement simply to put a few more $1,000s into their accounts. Man, was that an unfounded fear, Jeff thinks now. Year 2022. January adjustments. Jeff sits down the first week of 2022 and reviews 2021 numbers. Jeff doesn't really have anything to change. It's all humming along fine. Because the S&P 500 fund made so much money in 2021, he will pull his 2022 monthly withdrawals from that fund and let the reserve balance in the G fund just stay there. However, Jeff has realized one thing is different: prices. Seems like everywhere he goes, he's paying more for food, gas, and well, just about everything else too. It appears inflation might continue to be an issue in 2022 as well. After doing some thinking, Jeff decides to give himself a raise. You can do that when you're in charge. After some very quick math, Jeff decides to bump up his withdrawals another $1,000 a month for a total of $4,000. That would be $48,000 a year, twice what he was initially pulling out when he first retired. This would have given him some heartburn in 2018, but looking back at 2021, he realizes that he's only pulling up $48,000 from the $200,000 in profits, still leaving a lot of gains left in his account. Jeff even contemplates taking an extra lump sum to replace his old Forerunner. Let's keep an eye on the markets for now, Jeff thinks. He sets up his automatic monthly withdrawals from Schwab, and he sets off to see what 2022 has in store. January 2nd, 2022, Author's Note. I decided to track the markets through our fictional character, Jeff Fersonian, real time, with real historical numbers. None of this is theoretical or up for debate in any way. The data here is a hard fact and easily verifiable at www.tsp.gov. These few years have been outstanding for Jeff. However, my concern is that the reader somehow extrapolates this success as a sure thing for their own accounts into the future. Please understand that while these numbers are 100% factual, they are also very unusual. The long-term average return of the market is around 9%. The last 3 years, the market has returned 31%, 18%, and 28% respectively. Amazing returns. Will that continue for much longer? I don't know. It seems unlikely from a historical perspective. The point is, don't be overly optimistic and fall into the trap of thinking the market always goes up. It does not. If you recall, Jeff planned very conservatively in the beginning and has just started loosening up on the withdrawals after hundreds of thousands of dollars of gains. That's probably a pretty wise approach. He's still got his G fund set aside in reserve with somewhere between 5 to 10 years of withdrawals, just in case. That's one of the main characteristics of the barbell strategy. Plan for the worst, hope for the best. What is my point to all this? Simple. Don't plan for the best. See you in 2023. Year 2023. Sunday, January 15, 2023 to be exact. Let's check in on our old buddy Jeff. What's he been up to? For starters, his health is holding out well. He finally did get around to buying that new Forerunner he had his eye on. 2022 TRD off-road, army green, with a lot of extras. He's traveled around the country at a very leisurely pace. He's done a little hunting, visited with some old friends, caught a few fish, as well as a few sporting events. He's also answered a lot of questions from his former coworkers about what retirement is like. In short, he's thoroughly enjoying not answering Uncle Sam's government-issued cell phone. He hasn't missed the job even once. He is reminded of the phrase, "I don't miss the circus, but I do miss some of the clowns." But then again, his identity was never his government job to start with. Jeff sits down the first week of 2023 to perform his 30 minutes a year of financial planning. Step 1, review 2022 numbers and take inventory. Jeff does the math a few times. Is that right? I lost almost $200,000? Well, that's not good. Guess that makes the 2023 withdrawal decision easy. It's going to come from the TSP-G fund. Jeff is more glad than ever that he started this barbell strategy. If he had kept everything in the C fund, not only would he have lost a lot more, he'd have no other option for withdrawals than to sell his S&P 500 shares while they are low. This would not only lock in losses, but also require him to sell more of the now cheaper shares to keep up with his $4,000 a month withdrawal. At least now, he can pull from the G fund for the upcoming year and leave the S&P 500 to recover, hopefully. He's also glad to look and see that his G fund returned $7,664 this year and $3,501 last year. Those gains total over $11,000 he can withdraw before he starts to eat into his G fund balance. Jeff also realizes he made a critical tactical error during 2022. Even though his Schwab S&P 500 had gains of $207,000 in 2021, and he was pulling his $48,000 from that fund throughout 2022, the loss in 2022 was basically enough to cause him to use all of his 2021 gain. He used $48,000 and the account lost $160,000, so he wiped out 2021's nice return. If the market had fallen further, he would have wiped out even more and still be pulling from the S&P 500, further hurting his balance. In other words, he wouldn't really be pulling from the gains because the gains would have disappeared as the market continued to go down. He decided to modify his plans in the future and created a new rule for himself. In years that the S&P 500 does well, and I decide to withdraw from that fund for the upcoming year, I will first transfer the year's worth of withdrawals in January to a money market fund, or the G fund, to protect those gains from disappearing, to lock in those gains, and then withdraw from that money market fund, or G fund. In effect, Jeff is locking in his previous year's gain so he can ensure he is withdrawing only from gains, even if the market crashes and erases all gains from the previous year. Where do I stand now? Jeff sees his former coworkers in a panic over their TSPs. Some are even deciding not to retire just because the TSP is down. Jeff doesn't understand this at all, but thinking he might be missing something, he sits down to take stock of what's happened to his money since retiring. Jeff retired on December 31st, 2017. At that point in time, his total TSP balance was $800,000. Since then, he has withdrawn $146,000. His current balance as of December 31st, 2022 is $987,387. Jeff does the math a couple of times. Wait, I've taken $146,000 out of my retirement accounts, and my total balance is still almost $200,000 higher than when I retired. I'll take it. January of 2023, moving forward. Jeff gets up the nerve to face the TSP. He logs on and sets up his withdrawal amounts for the upcoming year. $4,000 a month, $48,000 for the year. He doesn't really need that much money, but it would be nice to have extra spending money, and hey, that's why I sacrificed all those years to save up. Jeff has read about the 4% safe withdrawal rate, and he realizes this withdrawal amount represents slightly more, 4.86% to be exact, but he's okay with that. After all, he's still ahead almost $200,000. Jeff is slightly tempted to move some of the G fund into the S&P 500 fund since it's down. Rebalancing, he thinks the experts like to call it. But in the end, he decides not to. Not this year, anyway. He'll revisit that in another year. Jeff's not into market timing, whatever that is. Jeff's 30 minutes of annual financial planning is done, and he's off to see what 2023 has in store. He's already got a few beach trips scheduled. He's become quite fond of the Portofino Resort in Pensacola Beach. He's even considering buying one of the condos there. Who knows? Maybe one of us will run into him there someday, walking the beach, or out with his fly rod trying to hook one of those big redfish on the bayside, or taking in a plate of burnt-end mac and cheese at Water Pig Barbecue. January 15, 2023 Author's Note. You can read what I wrote at the end of last year's update. I caution you not to be overly optimistic. Recent gains were very unusual. I encourage you to remember the market doesn't always go up, and I ended with don't plan for the best. I don't know what the market's going to do any more than you. That caution turned out to be very prescient for 2022, though. I cannot tell you how many conversations I had in 2022 with people who are very close to the age where they will begin using their TSP, and they were 100% in the market. Why, I asked. Two main answers I would often receive. Number one, the market averages 9% over the long term, and number two, I follow XYX TSP or Dingbat Diane or whomever on Facebook, and they said the allocation should be 100% in the market now. After all, they've made me a lot of money. Here's the thing. The market has averaged 9% over the long term. But there are periods when the market goes down and doesn't come back up for years. Like years. You can tolerate that when you're 25. You may not be able to weather that when you're 55. When you're 55 or 65, or whatever the appropriate age is, you are probably wise to put some money into a place where it is safe from extreme downturns. The G Fund is one of those places. But Chris, the G Fund doesn't keep up with inflation. Two things. Number one, the G Fund does keep up with inflation. And number two, if a positive 2.98% return is not keeping up with inflation, how is a negative 18% doing any better? As to number two, TSP allocation timing, I will not get on my soapbox yet again. I will simply state this. No one has ever come forward yet to prove that they have beaten the C Fund in their TSP by adjusting allocations over the years. No one has ever come forward to prove they could accurately beat the market by timing it, ever. Not just me saying that, that's Warren Buffett and John Bogle making that claim as well. Buffett bet $500,000 no one could do it. No one has. If your investments are keeping you up at night, or keeping you from retiring, or stressing you out in some way, might I suggest something might be broken? Please talk to a professional. Personal note. I retired October of 2022. I get a lot of questions if I'm going to employ the barbell strategy myself. I'm always transparent with you guys. The answer is yes, I already have. I took 70% of my TSP and moved it to Schwab and purchased SWPPX, S&P 500, C Fund equivalent, in November of 2022. I also left 30% of my TSP in the G Fund. I have not set up monthly withdrawals yet, but were I going to, I would withdraw from the G Fund for the upcoming year, 2023. The logic being I would let my C Fund, S&P 500, recover for 2023, and maybe the next year, or the next year. I think you all know the problems with the new TSP record keeper. It's an absolute mess. Not a day goes by I don't get an email complaining. The rules for transferring in and out of the TSP are still the same. You can still transfer money from the TSP to an IRA and then back to the TSP again later. However, while the rules are the same, the procedure seems not nearly as smooth as it was. So, if you plan on doing the barbell, the TSP process may not be convenient enough for you to transfer money back and forth throughout the year. Once a year is probably all you want to endure. I'll let you decide your tolerance for incompetence and pain, though. See you in 2024. Year 2024, Thursday, January 4, 2024. Old Mr. Fersonian is a tough man to track down. It took some doing, but I finally connected with him of all places at Top of the River restaurant in Gadsden, Alabama. I spotted his green 4Runner with the fly rod case on top as soon as I pulled into the parking lot. If there was any doubt, the personalized license plate gave it away. Feed TSP. Ha! Classic Jeff. Found him in one of the wooden booths in the back with an array of metal plates spread in front of him, containing sun-dried southern staples, mostly fried. Jeff looked tan, healthy, and happy. He was wearing a yellow Jimmy Buffett t-shirt, Fruitcakes Tour 1994. He was a bit surprised as I relayed how many of you were so curious as to what he was doing with his TSP, how it was holding up, and what he was planning on doing in light of the market returns of this past year. Over a catfish and a few cans of the best ginger ale ever produced, Buffalo Rock, bottled down the road in Birmingham, he shared with me his 2023 numbers, as well as his plans for 2024. Jeff almost lost $200,000 in 2022. He gained about $200,000 in 2023. He's come to the conclusion he likes the gains more than the losses. In fact, he's rather amused that his retirement accounts are now almost as high as they've ever been. That leads to some decisions to make. First decision. The stock market portion of his money has grown faster than the safe side of the barbell, the G Fund. When he started this whole process years ago, he wanted to have about 30% of his investments in safe money. Doing some math based on the new balances, his G Fund only makes up for about 20% of his overall investments. That makes him a little nervous. It seems the first order of business is to realign the accounts so that they are closer to his preferred allocation of no more than 70% in the market. This allows 30% to be protected no matter what happens. When he does that math, that's about $341,000 that needs to be in the G fund. Since he's been withdrawing $48,000 lately, and he's been happy with that number, so he'll continue, $341,000 gives him over 7 years' worth of withdrawals in the G fund, even if the S&P 500 goes nowhere. He quite likes that safety. He'll have to increase that G fund side balance, though. Second decision. As he's already decided, $48,000 seems to be fine for withdrawals for this year, at least for now. He'll continue that into 2024. Since the G fund is about $115,000 less than his desired 30%, he'll move that amount back into the G fund to protect it. Additionally, he'll take $48,000 from his S&P 500 and move it to the G fund as well to cover the future withdrawals for 2024. That would be a total of $163,000 coming out of S&P 500 into the G fund, leaving him with roughly $389,000 in TSP G fund and $749,000 or so in the Schwab S&P 500 after the transfer is made. Not bad, considering he retired in 2018 with a total of $800,000 in retirement funds. While explaining this to his wife, Judy, she asked, "Why bother with the TSP at all at this point? Why not just move everything to Schwab?" Jeff explained the concept of the barbell to her and how to protect one side of the investments while letting the other side grow. After some back and forth, Jeff started to see Judy's point. Maybe he just transfers all of his money into Schwab and splits it between the S&P 500 like he has been, and a money market account that pays roughly what the G fund is paying. He likes the simplicity of that. The real inconvenience in this system is the transferring of money to and from the TSP. They don't exactly make it easy. And now that he's over 59 and a half, there's no real advantage to the TSP from an early withdrawal standpoint. In fact, the TSP is really more of a hassle than anything. He'd love to be completely done with those. He made a note to think about that for 2024 and maybe consolidate everything in the future. It would certainly make things much easier for him. For now, he'll continue as is. TSP G fund for the safe side, Schwab S&P 500 for the growth side. Judy also had a couple of other questions. Why transfer the $48,000 withdrawals for 2024 back into the TSP? Since it's coming from the gains, why not just pull it all from the Schwab side? This is an excellent point, but Jeff reminds her of what happened in 2022. He was making his withdrawals from Schwab in 2022 because of the big gains in 2021. However, the market went down substantially in 2022, and those gains he had that he was withdrawing started to evaporate. That's when he made the decision to protect gains from the year before if he was going to withdraw them the following year. He had decided in 2022 that in the future, if he was going to protect gains, he would move them to a money market fund at Schwab from the S&P 500 side or back to the G fund. That would protect them, and he would withdraw from that money market throughout the year, with no fear of the gains evaporating. However, since he's transferring roughly $115,000 to TSP anyway, he decided for simplicity's sake to just transfer the $48,000 with it. He's already got $4,000 a month coming out of TSP set up with them, so now he doesn't have to alter that. He's put the full $4,000 a month times 12 months back into TSP for 2024, and he won't have to make any TSP adjustments. He also doesn't have to set up a money market account at Schwab. It just keeps things simple, and Jeff likes simple. He's too busy living life. True, the market went up a lot in 2023, but it just barely went up if you count the amount it went down in 2022, so it's not really ahead that much. Another good point by Judy. In fact, After Jeff makes his transfer from Schwab to TSP, his Schwab account will only be around $749,000 when it was $930,000 in the beginning of 2022. Jeff agrees with this math, but determines his overall balance is much higher than the end of 2022, even after the losses and withdrawals of that year. About $150,000 higher, in fact. And Jeff wants to keep roughly 30% protected, so he's okay with the S&P 500 portion being a little lower than it was in the beginning of 2022. It's still higher than it was at the end of 2022. He reminds Judy that the point of this strategy is not to necessarily beat the market or even to grow the account. The main goal is to set up a withdrawal plan that allows them to enjoy the money but limits the chances they'll run out of it in old age. And so far, so good. Jeff has taken almost $200,000 in withdrawals and still has over $300,000 more than he started with. This is with zero market timing, and as we've seen, Jeff only spends about half an hour a year even addressing this stuff, so there's no stress worrying about the money and trying to manage it 24/7. For the life of him, Jeff can't understand those that are always checking their TSP and worrying about what it's doing during the year. He occasionally meets former coworkers for breakfast, and they're constantly worried about TSP performance from day to day. He always thinks to himself, that's an end-of-the-year issue. Who cares what it's doing during the year, or on any given day or month? January 2024. Looking ahead. Jeff feels confident in his withdrawal rate for 2024. It's actually still in the ballpark of the 4% safe withdrawal rate he keeps hearing about. $48,000 divided by 1.13 million equals about 4.2%. That seems responsible to Jeff. Maybe he'll even give himself a raise in 2025. Who knows? He will also need to address taking Social Security in the near future versus letting it grow and continue to use his TSP. He's leaning to filing earlier rather than later. When to file? That's a big question, but a question for another day. Jeff and I finish off the last of the buffalo rock and fried pickles. He tells me he's got to go. Apparently, the reason he's in the area is to attend a bushcraft survival class at the nearby Randall's Adventure and Training School, whatever that is. That Jeff, he's certainly enjoying the freedom of retirement. As we walk through the parking lot, I ask him if he's missed working for the government at all. I could still hear him laughing as he got in the 4Runner and drove off. January 2nd, 2024, author's note. I always feel the need to issue a caution after a big year like 2023. These results are not the average. Don't feel overly optimistic moving forward. I often see federal employees that don't have the balance they would like to have as they near retirement, so they try to make up for lost time by throwing everything into the C fund, hoping that the next 2 years will override 2 decades of not contributing much. That's very risky. What happens if your balance you are already disappointed in shrinks by another 40% right before you retire? It's happened. A balanced approach is going to be better if you are getting close to the time in your life where you'll start using the money. Sure, keep some in the market, but protect some as well. For all the reasons talked about in the next chapter, keep reading. Personal note. People ask me all the time, yes, I'm still using the barbell strategy. I just have not started withdrawing money yet. Yes, I still have it split between only C and G, with no plans to do anything else. I still have my 70% in Schwab's SWPPX as my C fund. TSP-G fund has the rest. Like the rest of you, I really wish TSP would allow us to withdraw from a particular fund. If they would do that, how simple would this barbell method be for all of us? No reason to even transfer money to a separate account like Schwab. And yes, you could rebalance every month after you take your withdrawals from the TSP to artificially create the same 70-30 portfolio if you wanted. And feel free to do that. But this method is a once-a-year adjustment option for those that don't want to fool with the TSP transfers every month. All of that being said, seriously, people, who cares what I do? I want you guys to do what is best for you, Regardless of whatever method I employ, please come up with what is best for you because we are all in different stages of life, therefore different stages of investing. If I were in my 20s and 30s in the government right now, I'd be 100% Roth, 100% C fund, and I wouldn't even check the thing for years. I might revisit the Roth decision once I was in my 40s and was getting up in income brackets. But the point is, we are at different seasons, and what is 100% correct for one person may be incorrect for the person in the cubicle next to them. There is no one-size-fits-all in investing. There's also no reason to go this alone. Please speak to a professional to help you come up with a strategy that causes you very little stress. That's the goal. Year 2025, aka 7 years into retirement, Tuesday, January 7th, 2025. Here we are, back from another trip around the sun. It's January of 2025 and time to check in on everyone's favorite FERS retiree, Jeff Fersonian. This year, he wanted me to meet him at the Grand Marlin restaurant in Pensacola Beach. A mind-numbing drive down I-65 for yours truly, but hey, it's not supposed to be above freezing here for 2 weeks. Don't threaten me with breaking out the fish hippie t-shirts and duckhead shorts in January. So I grabbed the golf clubs, the MX Platinum, and Redneck Riviera. Here I come, baby. 11 hours and 3 buckies later, I spy the familiar green 4Runner in the parking lot as I pull in. There are a few more stickers on the back than last year. I find Jeff at a table along the railing overlooking the bay, diligently working over something operating under the rubric of a pusser's painkiller. Judy is with him this year. How is it they both look younger than last time? Tan, fit, and clearly at home in his retirement era, Jeff is a happy camper. He's sporting a faded sweatshirt from the obstinate daughter on Sullivan's Island. Interesting. We exchange pleasantries and pictures from fly fishing trips. FYI, the 4Runner has added another 50,000 miles on it and still runs like a top. And then, over an obscenely inordinate amount of barbecue-baked oysters, we get down to business discussing the now familiar 30 minutes a year investment plan. 2025 has been a good year all around for just about any investment, and Jeff's gains are no exception. Jeff's S&P 500 C fund at Schwab is up 24.96%, and his TSP G fund added 4.40%. For the math nerds out there, that works out to about a net of 18.79% on a 70-30 split with those returns. Amazing. Twice the long-term average of the stock market, while still protecting 30% of the overall investment in a risk-free government-guaranteed bond fund. I'd take that any year. 2024 analysis. Jeff continues to be absolutely astounded at his retirement accounts. He retired in December of 2017 with a total of $800,000. Since then, he has withdrawn almost $250,000, and 6 years later, at the end of 2024, he has $1.2 million or $400,000 more than he started with. Even after all the withdrawals. Wow, so far so good. Jeff would like to keep his safe money at around 30% of his overall investment total. Since the market has been doing so well, that's been tough to do. Currently, his G fund is only about 27.5% of his $1.2 million. He'd really like to start each year with at least 30% in there, so that is going to necessitate some sort of rebalancing, meaning taking some from the Schwab IRA and moving to the TSP-G fund. Jeff and Judy have been talking over the last couple of days in preparation for this meeting, and they've started asking themselves, why do they even bother with the TSP at this stage? What is really the point of transferring money from Schwab to TSP and possibly back? It seems to be a pain, and they aren't sure exactly what it's getting them. So let's look at that for a second. They are correct, first of all. It is a pain to transfer money to or from the TSP. I've done it. I know. It's also scary. They don't make it easy, efficient, safe, or modern. Wouldn't it be easier to just move the G fund money over to Schwab and then just have all the money in one place? The short answer is absolutely. It would be easier, no question. The private sector brokerage accounts are much more user-friendly for a variety of reasons. No spousal approval needed to make withdrawals, a much more robust website, and even standalone branches that you can go visit, sit down, and meet with an actual person, something a TSP holder can only dream about. But I thought there isn't a G fund in the private sector. That's correct. There isn't a 100% equivalent. The G fund is the only fund in the TSP not available outside of the TSP. It's comprised of special U.S. Treasuries available only inside the TSP. But isn't there some sort of rough equivalent out there? I mean, after all, when you get down to it, isn't the G fund essentially just a high-yield savings account? Yes, one could very well look at it that way. So is there something that can accomplish almost the same thing at Schwab? Well, let's see. Jeff has been doing some research and has landed upon Charles Schwab's U.S. Treasury Money Fund, ticker symbol SNSXX. According to the fund documents, he reads the following. Objective. The fund's goal is to see the highest current income consistent with stability of capital and liquidity. Seeks to generate income while maintaining liquidity. Typically invest in securities backed by the full faith and credit of the U.S. government. Jeff knows it's not the exact same thing as the G Fund, but it seems close enough for him. It beats just putting the money in a checking account at 0.1% interest. When he looks at the 1-year, 3-year, and 5-year returns, they are very close to the G Fund's returns over the same periods. The fee is a bit higher, 0.34% versus 0.049%. That eats into the returns a bit, but nothing that worries him. Maybe he can find something better with some more research. But for now, Jeff would very much like the simplicity of having all his money in Schwab and avoiding these transfers back and forth from TSP. To him, that is totally worth the 0.34% in fees. If he were still under 59.5, this would probably not be his desired approach. The TSP allows penalty-free withdrawals prior to 59.5. IRAs do not. So prior to hitting that magic age, withdrawals are probably best from TSP to avoid the 10% early withdrawal penalty. Now that Jeff is past that age, the TSP holds no attraction to him in that regard. Closing the TSP? Jeff has made up his mind. He's moving his TSP one last time, everything over to Schwab, well, almost everything. Jeff has read that if his TSP balance ever falls below $200, they will close his account and he'll never be able to get back in. He doesn't want to burn that bridge. Who knows what the future will bring? Maybe laws change. Maybe fees change. Maybe at some point in the future, the TSP will clearly be better than Schwab. He wants to leave that option open. That way, he can transfer his Schwab back into the TSP in the future if, for some reason, that becomes advantageous. He knows he needs to leave $200 in there. He's a belt and suspenders type guy. Why not leave $1,000 in there in the G Fund, just for a cushion? Seems the right move to him. Analyzing the upcoming year's withdrawals. Jeff has been taking out $48,000 a year. That's been good. But he'd like to bump that up a bit. He feels like it's okay to do so. Things aren't getting any cheaper after all, and he's not getting any younger either. He's read all about the 4% safe withdrawal rate. In fact, that's kind of what he's been following. But this year, Jeff's going to bump up his withdrawals to $60,000 a year. Based on his ending balance, that would equate to about 4.6% a year. Slightly over the 4% many people agree on, but not by much. And it does provide him with an extra $1,000 a month pre-tax. Since his S&P 500 account has done so well this year, he'll take the $60,000 withdrawals in 2025 from his Schwab S&P 500 side. Now he's got to move some money around. The execution for upcoming 2025. Number 1. Jeff's decided he wants to use Schwab's SNSXX as the private sector equivalent to the G Fund. Number 2. He transfers $355,005, everything except $1,000, from TSPG fund into Schwab IRA and places it in SNSXX. This leaves $1,000 left in TSPG fund. Number 3. This gives him a total investment balance of $1,292,209. He wants that to be 70% stocks, 30% bonds, so he needs to rebalance. Number 4. 70% of $1,292,209 is $904,546. 30% of $1,292,209 is $387,663. But he also wants his $60,000 of upcoming transfers to be in the bond portion of his account. So he also needs to transfer some more into the bond portion, which will end up giving him actually more than 30%. Number 5. When he rebalances to 70-30 plus the $60,000 in the bond portion, SNSXX, he ends up with $844,546 in SWPPX, S&P 500, and $446,663 in SNSXX, bond fund, and $1,000 in TSPG fund, also a bond fund. Number 6. He sets up recurring withdrawals from Schwab of $5,000 each month to come out of his SNSXX funds into his checking account. Number 7. Eats a couple more oysters. Jeff is happy with what he's decided. Things are simpler now. He's done with TSP for the most part. He's surprised at how happy he is that he's now done with all the transferring back and forth to TSP. It seems greatly simplified. Everything is at Schwab and set up for 2025. If you do the math, you'll see that 65% stocks, 35% bonds. What happened to the 70-30 ratio we were shooting for? Well, we are exactly there, except for the $60,000 worth of withdrawals moved from the stocks to the bonds for 2025. Jeff has made the decision to move his withdrawals over to the bond account ahead of time so that even after he takes them out, he'll still be at 70-30. That last point may seem complicated to some of you, but the second I leave that little detail out, my inbox will fill up asking, do you include the withdrawals in the 70-30 split, and if so, which side? Jeff chose to do 70-30 split and then add $60,000 to the bond side. Bring on 2025. January 6, 2025 author's note. I know I say this every year, it seems like, but once again, I really want to caution you guys. Do not get used to these returns. This is highly unusual. It's fun to have back-to-back 26% and 25% returns, like a lot of fun. But please don't be too optimistic moving forward. This is not normal. We will have a down year at some point. I'm not predicting when. I don't know. Neither do you. That's why we don't try to trade our retirement accounts. We invest for the long term. But if that long-term average of the stock market is around 8%, that means at some point we're in for a pretty steep correction. The flip side of that admonition is exactly why we stay in the C fund, even when there are so many predictions of market crashes, recessions, etc. There's been no shortage of predictions of crashes over the last couple of years from the experts on Wall Street. They've all been wrong. Had you been waiting in the G fund for just the right time to buy back into the C fund, you've missed out on absolutely phenomenal gains. The best investors seem to always be at least partly in the market. Successfully timing the market is just pure fiction. Don't be so arrogant as to think you can consistently pick the top and bottom of market movements. I would not be surprised if the next time I update this in January of 2026, that Jeff's total balance sits at $900,000. I would also not be surprised to see it at $1.4 million. As Yogi Berra said, it's tough to make predictions, especially about the future. Have an investment plan that works if the market goes the way you want it to or the way you don't want it to. I'll reiterate again because so many of you don't understand what the barbell strategy is designed to do. It is not supposed to beat the market. It is not even designed to grow your account every year. It is merely a systematic way of withdrawing money from your account while keeping some money in a safe fund and other money in a more aggressive fund. The balance between the two allows a person to protect some of their money but also participate somewhat in any gains that the market may make. It's not some silver bullet to make sure your balance never goes down. In all likelihood, that will happen eventually if you continue to make withdrawals. And there's nothing wrong with that. That's the normal course of things. And presumably, you sacrificed and saved this money all these years to actually use it. Otherwise, what was the point? Also, I'm not recommending SNSXX or SWPPX or any other investment, including the C or the G funds, or even the TSP itself. That's up to you guys. I'm just showing how a person could institute the barbell strategy themselves using the TSP and an investment similar to the TSP. People write me all the time and ask, can I do insert whatever in the barbell? You can do whatever you want. There are no rules to this. It's not a law. It's a system with some rough guidelines that can be altered at will by anyone that is so inclined. One final note. Is all of this necessary? Absolutely not. I just feel like the default is to stay in the TSP until you're 100% sure you want to do something other than the TSP, be it barbell or something else. If you're thinking, Chris, I can just keep my money in the TSP, and then each time I take a withdrawal, I can rebalance it between C and G or whatever. You're 100% correct, and if that's what you've decided after considerable thought and weighing everything, I'm all for it. The barbell is just for those who want something a bit simpler, and maybe those that aren't exactly, shall we say, content with the TSP. Let's do this again in 2026, shall we?
Chapter 5. Putting it all together. Hopefully, this continuing example isn't too childish or trite. I backed up a few years instead of starting Jeff's retirement in 2020 when I first started writing this. I wanted to use actual returns over the past few years so you can verify everything yourself, and so that it wouldn't just be some theoretical exercise of me pulling numbers out of the air. Because as soon as I do that, I'll get an email that says, your assumption might not be true, then what? Gotcha. Someone may ask when they should make the transfers, if any are needed. Probably the easiest thing to do would be to sit down in early January and evaluate the previous year's performance, then adjust accordingly. In the example above, just to make it simple, I placed the transfers for the year in the first couple weeks of January. When you do it is up to you. Our friendly neighborhood retiree had only been pulling $24,000 a year, then $36,000, $48,000, and now $60,000 in 2025. These withdrawal amounts may have been around the 4% rate, sometimes higher, sometimes maybe lower because of the gains in the account, but it has hovered around the 4% mark. As you can see, his overall balance has been growing regardless. He left the government with an $800,000 balance that had grown to over $1.2 million even with his withdrawals. These are real numbers, folks. This is what the accounts actually returned. This is not just some theoretical model like so many of your TSP allocation services you subscribe to. Having said that, we could go back and cherry pick some time frames where the markets did not do well at all. Look at early 2000 to 2002. The market lost almost half of its value. If Jeff would have retired at the end of 1999, things would look very different. There would have been 3 years that Jeff would have been pulling from his G fund and hoping that C fund, S&P 500, would turn around and get back on track. If you remember, Jeff decided to protect 10 years worth of withdrawals. That would have been wise in the early 2000s. The bottom line to all of this is simple. If you are employing the barbell strategy,
You pull from the profits in the market during the good years and use the G fund to get you through those years when the markets are down. The G fund is not really there to make you money. That's fine. That's not its purpose. It's there to protect the money you've already made, and it does a superb job at that. It acts more like a cash account, a savings account, or a money market account, which is perfectly fine for our purposes. That is not the side of the barbell where we want to make money. That is the side where we want to not lose money. Please understand that distinction. I want to be clear on this point again. The barbell is not meant to be a way to somehow beat the market. It is a strategy for drawing down your balance in a systematic, controlled way that offers you options when the market is down or the market is up. In effect, it can reduce stress by always providing you with a decent choice, regardless of what the market is doing. The fact that Jeff's balance has grown is not some promise that yours will grow in the future. The main purpose is a way to withdraw responsibly from the account, not to figure out a way to withdraw while also letting it grow. It may happen like that, but there's no guarantee at all. Now, if we can imagine something for a second, put yourself in Jeff's place. Let's say you had the exact same setup as him and you were retired. Imagine we are in January of 2020. I know. No one wants to relive that year, but bear with me. Life is still good. One new market high after the other. Then you start hearing news reports of some weird virus. Wait, bat soup is actually a thing? 2 months later, what was worth $700,000 is now worth $490,000. You've lost $210,000 in 2 months. That's nerve-wracking. If you had everything in the markets, you may be tricked into panicking and moving it all into the G fund to protect what's left. Just wait until this whole thing blows over. But before this whole thing just blows over, we are deep into election season. Now the temptation is to think, I'll just ride it out in the G until the elections are over. Think of the mistake that would have been. But by January of 2022, we know now, we hit 68 new highs throughout 2021, then a bad 2022, then new highs in the TSP in 2023 and 2024. We were 119% higher in 2023 than we were in March of 2020. Your $490,000 was worth over $1 million, assuming you kept it in. Now, change some things around. Let's go back to March of 2020 again, but this time you have what Jeff has, 10 years worth of withdrawals protected in the G fund. Would that have brought you peace of mind? You're probably a lot less likely to move that C fund out of panic, right? You're probably more likely to think along the lines, well, this is rough, but I can ride this out for years. No reason to do something rash. The virus will eventually be under control and will recover. See the difference? In one scenario, you don't have a plan, you have nothing protected, and you are more susceptible to panic. In the other scenario, you've brought yourself plenty of time to let the market do its thing. There's no need to make a decision of any kind. You can sit back and watch all of the panic with mild amusement. You're immune from it. Protecting some money protects peace of mind and buys you years of the ability to sit back and watch. As the late great John Bogle used to say, don't just do something, sit there. That, in a nutshell, is the heart of the barbell strategy. It is simple. It buys you time. It buys you peace of mind. It protects some of your money for accessibility, but keeps some in the market to outpace inflation, hopefully. Chapter 6. Final Thoughts. I will close with just some final things to consider. As I mentioned in the beginning, this is not the strategy for how to deal with your TSP during the withdrawal phase. It might not even be particularly appropriate for you. This is just one of many options, and this isn't meant to be a comprehensive financial profile or case study. There's a lot I didn't cover in here. I'm not convinced the average government employee will read 30 pages, much less 100 pages, if I included things like taxes, Roth conversions, etc. So I try to make it brief enough to keep thoughts of suicide at bay, while giving enough detail for someone to follow it if they were so inclined. I get a lot of questions and comments on the barbell strategy, so I thought I would expound on it and give a clear, if somewhat cartoonish, example for the average person to follow. If you want to completely dismiss it as worthless to you, feel free. There are numerous strategies out there that compete with this one, and you may have already found one that works for you. Some of you may never want to take anything out. It's RMD or bust for you. Your entire strategy is trying to figure out a way to never get to all that money you sacrificed all those years for. Others may take everything out of TSP and give it to an advisor to manage. Do what is best for you, but please understand the pros and cons enough to explain it to someone else before you do it. The same goes with the strategy in this book. I've used the term risk-free a few times in this book, but the reality is nothing is truly completely riskless. Even the G fund has inflation risk that inflation will eat away at the real buying power of your investment. There is market risk, the market might crash, credit risk, companies may go bankrupt and not pay your bond interest, and a whole host of other kinds of risk. That is why you diversify and protect part of your assets from the various kinds of risk the best you can. Talk to a professional about some of the ways to accomplish what you are concerned about. I do not mean to endorse any of the funds or companies in this book. I try to provide a good cross-section of the more popular companies. I personally use Schwab for my brokerage and IRA accounts, but Fidelity, Vanguard, T. Rowe Price, and many others are great companies that offer virtually the same products and at the same fees. Fidelity and Schwab even have multiple zero-fee products. Probably others do as well. Stay with the bigger names, do your due diligence, and you'll be okay. Buying something from Carl's Bait Shop, Oil Change, and Financial Planning would probably be considered suboptimal. I get this question a lot, so I'll address it. Do you need a financial advisor in retirement? No, you probably do not need one. Be careful though. That is not the same as saying you won't benefit from one. But you have to understand what you're looking for. Unless you're specifically wanting someone to take all of your TSP and manage it for you, I personally would stay away from those types of advisors. I find them to be expensive based on the FERS retirees that I have seen hire them. Here's my take on that. If you've managed to accumulate $600,000, $800,000, or even over a $1 million balance in your TSP by yourself, you've done an outstanding job all by yourself. There might even be a good chance you will have a higher investment account balance than the financial advisor you're thinking of hiring. So who's teaching whom? However, I realize some people are willing to pay the extra fees to have a professional take care of everything and just try to make it grow the best they can, even if it costs a lot more than the TSP fees. If that's you, go for it. I support you. Make sure they are reputable and all of that, of course, and please make sure you fully understand the cost. They will be substantially higher than the TSP, that I can assure you. Whether that cost is worth it or not is one for you to decide. It may very well be. You may consider it the best decision you've ever made. You do get some benefits to this approach. You get a person you sit down with monthly or quarterly to go over things. You can call them to talk you off the ledge during market crashes, and that access and peace of mind may be well worth it for the added expense. For the rest of you, what you will probably benefit from is the planning side of what advisors have to offer. Set aside the managing function for a second. An advisor can sit down with you and help you come up with a long-term plan that incorporates multiple aspects of your financial life. How conservative do you want to be? What is a safe amount to withdraw? When should you file for Social Security? Should you do a Roth conversion? And the big one, what moves can you make to minimize the tax consequences? This is where I think a good advisor is worth it. They typically have software that can run various scenarios that provide you with enough information that the decisions become easy. That's what you're looking for, education that leads to good decisions. A good financial planner will know about taxes related to income and investments, but he may not be a CPA. Some CPAs may specialize in taxes related to investments and do some light financial planning, but not all will. Some may just do tax prep and not too much tax advising. You just need to do your homework into what that individual professional does. There's no solid universal answer here. Don't just look at the designation and blindly hire them. You may have noticed that I have not specified whether the TSP we are using is the traditional or the Roth. I need to address some more little quirks about the TSP. If you have the traditional TSP, all of what we have discussed so far is accurate. If you have the Roth TSP, you have a few issues to deal with. Number 1. The 55-year-old, or any age for SCE, TSP withdrawals do not apply to the Roth TSP. For now, that age is still set at 59.5. That may complicate your barbell strategy attempts, but maybe not. You could just use the traditional TSP balance for the barbell and treat the Roth TSP separately. Number 2. Even if you are over 59.5, you have another hurdle. Transfers involving Roth TSP can only go one way, out of the TSP. You can transfer a Roth TSP to a Roth IRA, at Vanguard for example, but you cannot transfer a Roth IRA to a Roth TSP. The TSP just will not accept transfers in from a Roth IRA. So if you revisit our buddy Jeff, you'll notice on really good years when he was under 59.5, he moved the gains from his IRA into his TSP to withdraw them from TSP penalty-free. This would not be possible with a Roth TSP. Just keep that in mind. There is also a 5-year wait rule in a Roth IRA you'll have to satisfy. Read up on that. Really, if you're going to be moving money, you really should talk to a professional to help you avoid the pitfalls. I did not specify in the example if Jeff is regular FERS or special category employee, SCE. It really doesn't matter for our purposes since he retired at his MRA. If he were SCE, he could retire as early as mid-40s now and still make penalty-free withdrawals from the TSP. If he were regular FERS, he would have to wait to retire until the year he turned 55. Since he retired at his MRA in 2017, he would be over 55 anyway. What happens if you retire before your particular 10% penalty exception? You don't get to make penalty-free withdrawals when you turn 50 or 55, as some people think. You actually have to wait until 59.5. So be careful and talk to someone when planning for retirement. There is a way to retire earlier and avoid this 10% penalty, but it comes with a series of significant restrictions. 2023 update for special category employees. You can now withdraw your TSP when you retire after 25 years, even if you are younger than 50. This is part of the Secure Act 2.0. Read up on it. A note of thanks. If you've gotten this far, I appreciate your time. It is never lost on me that time is our most valuable resource. I constantly see people chasing money when what they should be is chasing time. It's worth far more. As with everything I write, this is completely free and shareable with everyone. In fact, I encourage it. I didn't write this to help me. I wrote it to help you. So if you know someone it may help, please forward it along. If you disagree with it, that's perfectly fine too. We can still be friends. As long as you don't pull for Clemson, that's unforgivable. If you disagree with it, that's perfectly fine too. We can still be friends. As long as you don't pull for Clemson, that's unforgivable. Check out the resources page. There are 2 advisors listed if you want to speak to a professional. I always make it clear that I get 0 compensation for any of my referrals to anything or anyone. These are just a couple of guys who understand FERS, who won't cheat you or try to sell you an annuity. Wait, aren't those 2 things the same? And are competent. Feel free to use them or to go somewhere else. I just provide them as options. Everything is listed in alphabetical order as well, not by any sort of ranking. Finally, What's in store for the markets? I don't know. You don't know. And based on the records of the experts in 2023 and 2024, they don't know. Lots of people called for a serious recession in 2023 and into 2024. Most financial experts were horribly wrong about it in 2022. Most were horribly wrong about 2023 and 2024. As the saying goes, it's difficult to make predictions, especially about the future. Everyone I talk to has a plan for what to do as the markets go up. Few have a plan for what to do when they go down. I suggest you have both. What scares me for 2025 is so many of the banks and investment firms on Wall Street are predicting an up year. When the experts think the market is going to go up, I get worried. They aren't exactly known for their accuracy. Congrats! We made it to the end, and another year. I truly wish all of you the very best in 2025, and comfortable, secure, and long retirements making great memories with family. But don't forget, money is never the ultimate goal. Don't believe me? Look around. There's no shortage of utterly miserable rich folks. Mark chapter 8, verse 36 reads, "And what shall it profit for a man if he shall gain the whole world and lose his own soul?" Money is merely a tool to be used for good. Go make a lot of it, but then be wise with it. Do a lot of good. The world certainly needs it. Until 2026, Chris.